Hi everybody. This video is going to explain why, in our opinion, based on technical analysis, Google is positioned very well to challenge its all-time high around $715 and likely move beyond it. Now, we're going to analyze Google by looking at a 3-year weekly chart. So this chart actually dates back to March 2009 up to the present date. We're also going to compare Google to tech stocks like Apple and Amazon and show some of the differences in the chart and what they might mean and how we're interpreting those differences. Now, the first thing we want to point out is that coming into 2010, so 2 years ago, Google was right around $625. So if you own Google, if you bought Google on January 1st, 2010, maybe it was your New Year's resolution to buy Google that year, who knows, and you've held it for 2 years, up until late last week, you were essentially looking at a flat return. Google, from the beginning of 2010 to the end of 2011, pretty much went nowhere. Now, of course, it's traded in a wide range over that time, but insofar as just an actual return year over year, Google has greatly underperformed relative to a stock like Apple, which you can see was around $200 coming into 2010 and now is up over 100%, above $400, throughout 2011. Amazon as well, in 2010, came in around 128, and then throughout 2011 hit a high of 240. So well over 80% return for Amazon. So Google has been kind of the laggard relative to other high-flying stocks like Amazon and Apple. But the thing we want to focus on here right now is what happened the last couple years. You can see Google traded in a wide range from about 630 on the high side and 480 on the low side, with the exception of July 2010 and a brief stint in September 2010. Google never really went below 480. So this is what we would call a long-term consolidation pattern, when the stock just goes kind of down, then up, down, then up, down, up, but in the grand scheme of things, doesn't go anywhere. Remember, from 2010 beginning to ending 2011, Google's pretty much where it started, flat. Now, this consolidation, though, represents a lot of changing of shares going on. And the thing that's different about this relative to a stock like Amazon, for instance, is Amazon has pretty much just been on an uninterrupted uptrend. So there hasn't been a real long period of consolidation anywhere for Amazon. So it's kind of tough to know, where will Amazon consolidate? Where will it find support? And where is the major resistance going to be? With Google, you don't have that problem, because for 2 years you said, okay, well, when it presses up above 600, there's a lot of resistance up here, as evidenced by this move away here from 600 to 630, and again here, again here. Vice versa, you could say, okay, when Google gets around 500 or below, you better start buying, as evidenced here, 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 and here. Now looking at Amazon again, you really only have this one major trend line to follow that you can say, okay, if Amazon bounces off this trend line, you want to buy. But that's kind of backwards looking. You know, you couldn't say when Amazon was getting up here around 150, which was an all-time high at the time, it was kind of just a luck of the draw if you wanted to sell up there or not. There wasn't any real historical reference to say, okay, there's going to be sellers up here on Amazon, there's going to be buyers down here. And you can see that the whole way up. So while it's great if you're in the stock because you're benefiting from a tremendous overall uptrend, it can be very difficult to pick your entries and exits if you're on the sidelines looking to build a position in Amazon. And when the stock starts to pull back, it can make it very difficult to determine where you want to buy shares at. Look at this huge drop from 246 down to 166. We're talking about a drop of about 30%. Google, while it has had some big drops, they've never been so violent because people always know where Google is coming from and where it is likely to bounce off of because of this long period of consolidation. Apple is another stock. It's a great stock if you've been holding Apple and long Apple. It's just been on a beautiful uptrend. And this one is your major uptrend line where actually you could have timed your buys pretty well compared with Amazon. You could have bought here around 200. You could have bought here around 240. You could have even bought here around 300. And you'd still be sitting pretty. You could have even bought here around 360. But our problem with a stock like Apple right now is what happens if this uptrend line breaks? Similar to Amazon, we don't have any very long period of consolidation that we can point to and say, boom, the buyers are going to be there because that's where it consolidated for so long. So people who are on the sidelines are likely looking at that area and that's where they're going to look to initiate a position. You can't do that with Apple. If Apple falls below this trend line, it's going to turn into a guessing game. Maybe 310 is going to be buyers, but I mean from 410 down to 310, I mean we're talking about a drop of, 30% again. 25-30%. So that's very violent. Furthermore, on the upside, Apple is at all-time highs, so if it breaks 426, it's kind of anybody's guess where it's going to top out at. 450 maybe, psychologically, 500, who knows? So the rewards can definitely be there, and traders really like uptrending stocks like an Apple. But something very important happened in Google late last week, and it's continuing today. Google is starting now to break out of this long period of consolidation. You can see the breakout point was right around 630, 635 area. Last week, Google tagged a new 52-week high, closed the year out at 52-week highs. Amazon and Apple cannot say the same thing. Amazon and Apple can boast a 100% gain over the last couple years, and Google cannot. But in the market, we care about the here and now and what is the outlook moving forward. We don't care about all the gains that were made in the past. We want to know what type of gains can we make now. So the beautiful thing about this is Google still is not yet at all-time highs. You have to go back to 2007. You can see the all-time high was around $747 set in November 2007. Now, to us, we don't see anything in the way of Google between here and $700. Look at this beautiful consolidation, this beautiful breakout. You can see it, we're looking at a monthly chart now. You can see 630 really tends to be the breaking point. That was the breaking point in October of 2007. It broke 630 and shot up to 700 later that same month. So to us, it's pretty much all systems go for Google. And you know, it really looks positioned to re-challenge this high. So we're very bullish on Google. We think that this area, this 630 level that acted as resistance for numerous occasions over the last 2 years, is now going to turn into support. So we would be buyers of Google on any dips that come back into the 600 to 630 level, because if you look, this area was definite resistance for a lot of 2010 and 2011. So now we expect it to turn into support. And a pullback from the current price of 660, you know, down to 600, we're talking about a very manageable 9%, 10% pullback. Nothing scary, nothing like Apple or Amazon where there's a risk of a 25, 30% pullback, very sharp, very sudden. And just to show an example of other stocks that have just had tremendous uptrends and never really experienced any consolidation, and what has then happened when the uptrend breaks, take a look at Salesforce.com. Great performer from 2010 through 2011. Came in around 70 bucks, hit a high in 2010 of 151, and then hit another high in 2011 of 160. So a great return. But look at what happened here in early August once that trend broke. From 148, broke the trend line around 125, and then within a matter of weeks traded from 125 all the way down to $95. That's a pullback of 25%. And it still is looking for a bottom, still hasn't been able to find, you know, where is the bottom going to be. Green Mountain Coffee, GMCR, tremendous uptrend here. Came in, you know, returned well over 100%. But then look at what happened. Beautiful uptrend from 32 all the way up to 115. The chart just went absolutely parabolic. But then look what happens once it loses its trend line. From $90 crashing down to a low of $34. I mean, that is over a 50-point drop, well over 50% decline. And to us, the reason is because there was no long-term consolidation pattern or anything for people to look at and say, okay, that's where the buyers are. So once that trend line broke, everybody just ran for the hills. Lululemon is another one, ticker LULU. Great uptrend. But then once that uptrend started to break in mid-2011, around $54, a pullback pretty much right straight to 41 over the course of a couple weeks. And we're talking about a 25% pullback right there. Of course, the granddaddy of them all, Netflix, which had just an absolutely beautiful uptrend working for it for much of 2010 and 2011. But then once it lost that uptrend, around $250 per share, within 2 months, 3 months' time, Netflix was trading at $70. We're talking about a decline of nearly 75%. Now, we're not saying that's what's going to happen to Amazon or that's what's going to happen to Apple. But what we are saying is that the chances of something like that happening to Apple or Amazon are much, much greater than the chances of something like that happening to a stock like Google. Furthermore, because of this consolidation, we know that if Google does pull back and it goes below these previous levels, say that 600 to 630 range, that's a red flag. So we can notice the red flag at a 10% pullback right away, right off the bat. Whereas Amazon and Apple, you're going to have a hard time identifying any red flags as soon as that trend line breaks. Once that trend line breaks, it'll be very hard to pick the bottom, and it's likely going to take a very long time for the stock to consolidate and find a bottom. Look at Netflix. Netflix is just now starting to do some consolidation. Green Mountain Coffee is just now starting to do some consolidation. Lululemon is just now starting to do some consolidation. Salesforce hasn't even started to do some consolidation yet, and it still looks like it could go a lot lower. So in the end, the takeaway here is that while a lot of people will tell you to look for uptrending stocks, and those are the most bullish setups, while we do agree in some cases, you've got to remember that the longer a stock has to consolidate, the more knowledge you will be able to trade that stock with, and the more powerful a breakout will likely be. So hopefully this video explains why Google is best positioned relative to its technology peers, and hopefully everybody can benefit from that. Now, we invite anybody who hasn't done so yet to sign up at stockhaven.com. Simply type in your email address there, and you'll receive videos like this one directly to your inbox, which we've gotten a lot of feedback from members that these are very helpful with their trading. So on that note, we wish everybody a good green start to their 2012 trading year.